Well, good day, everyone. Welcome to our January monthly production stream webinar. I was about to say I can't believe that it's January, but what I really mean is I can't believe that we're like 4 days away from January being over. So this is wild. Heck of a month, certainly. I hope everyone is thawing out a little bit from the storm, over the weekend and earlier this week. Obviously, we've got a good show for you today. We're going to go 30 minutes. And this January really presents an opportunity for East Daley to talk about our prognostications for 2026. So let's go ahead and meet the team. Hello, team.
Oh, Jack.
All right. So we got Jackson, Julian, Keelan, Maria, and Ian in the room with us today. And they're going to give us their impressions of oil, gas, and liquids markets for the year ahead. I won't spend too much time on what we do, but basically the tagline is we go from wellhead to demand, right? And so let's get to it. So our kind of three main focal points for kind of 2026 is that this is the year that U.S. energy is going to go fully global, right? There's good things about that. Obviously, you have access to enhanced demand markets, right? The troublesome part is that you import volatility and geopolitics into U.S. basins, right? A good example of this is obviously like what's the influx of Venezuelan crude oil going to do to our friends in Canada and our own very own refineries along the Gulf Coast, right? So think about it in those contexts. Gas is the growth engine for the marketplace, right? But it has its own challenges. One is producer capital discipline. One is timing of infrastructure additions, and then lastly, political hurdles, right? And then finally, and then Jackson's going to help us out on this, but capital strategies are shifting. The more things that are out of your control has led companies to basically focus on what they can control. So we'll examine a couple strategies along with some non-core assets at the end of the presentation to talk about how companies are thriving or approaching these increasingly geopoliticalized markets. But first, let's hear from Maria on the macro production outlook. Exciting things.
Yeah, exciting. Because of that, we changed our new format to give you out some insight of what we think it's going to be the 2026 outlook. For crude oil, on average in 2025, the production will be 13.58 million barrels per day. And looking ahead to 2026, our production expectation is that it will remain relatively flat and close at 13.62 million barrels per day. Moving to natural gas, on the dry gas side, production average for 2025 will be 107.2 billion cubic feet, and it will rise to 111.4 billion cubic feet on 2026. And this reflects basically the changes on demand that we're expecting, right?
The growth engine. Yep.
Mhm.
Yep.
The NGL side, we expect that 2025 average will be 7.46 million barrels per day, and it will increase to around 7.75 million barrels per day in 2026. And this is obviously correlated to gas at the end of the day.
So Julian, about 300,000 barrels of liquids growth on 4 BCF a day of production, gas production.
Yes.
Okay. Cool. All right. Well, thank you, Maria. Very helpful. This kind of sets the stage for talking about going global, right? So did you know, Jackson, that 1/3 of U.S. hydrocarbons now clear global markets if you include refined products?
I did, Jack.
He did, yeah, because he's been dancing around Houston for the past 2 weeks, shouting it from the rooftops. But the point of this slide really is to show, over the length of our forecast period in 2030, just how much weight gas is kind of carrying here, right? biggest growth profile. It's going to take more than just the Haynesville, the Permian, and the Northeast to provide this slide, to provide this level of production. And what's behind it largely is 15 BCF a day of LNG feed gas demand, right? We'll take a look at it in detail in the next slide, but pretty wild. For crude oil, the forward curve is not incentivizing a lot of growth. You saw Maria's numbers from the prior slides showing basically a flat 2026. We have a flat-ish outlook through 2030 with only 600,000 barrels of growth. Then finally, as we know, NGL production, growing because gas is growing, but its constraint is that it must make it to the water. It must clear the export dock. So Julian will jump into that when we get there. Let's talk about LNG real quick, right? So overall, our call for 2026 is for about 3.9 BCF a day of increase there on average. We should be averaging 20 BCF a day on the regular through in November of 2026. What does this mean? Basically, you have to have the production to support it. You will have some volatility on the way there, and you have to have infrastructure to support it. Lastly, I guess if we look out through 2030, right, a total of 31 BCF a day of feed gas demand. Most of these projects that we're talking about have already been FID'd. 2025 was kind of the year of FID with about 12 BCF a day projects coming and getting that financial backing for the year. We expect a few more facilities to come this year, most notably Commonwealth and Texas LNG, which could both announce as early as this quarter. Keeland, talk to me about what's going on in crude, not to put on a sour subject here or anything, but what's happening? Why aren't we growing?
Well, thank you, Jack. Just want to point out that the crude oil story is a little different than what we're seeing in gas and NGLs. As a slowdown in global demand is kind of becoming more and more evident. But as you can see on the graph right there, for the past 15 years, incremental demand has been largely met by U.S. supply. However, that tide is changing. Another thing I kind of wanted to point out, it's an interesting dynamic that kind of happened in the Permian. In 2022, you saw about 175 rigs were operated by private Permian producers, and that number has now dropped down to 60 rigs that are operated by privates. And with that, you're seeing a lot of consolidation. And with that consolidation, producers are now they're focusing more on managing inventory and capital discipline. This is striking a shift from that volume growth strategy to one of free cash flow. And then third thing I kind of want to point out is going forward, we see Saudi Arabia, OPEC, Latin America, and Canada are now going to become those marginal producers. It is no longer the Permian as prices have fallen below $60.
Okay. Well, different strokes for different folks, right? Good. All right. Now, Julian, with liquids, what's going on here?
Yeah, thank you, Jack. So move the NGLs or shut in the gas. And really what we're saying here is that the natural gas liquid value chain can be a constraint on the natural gas value chain. When we talk about 1/3 of United States hydrocarbons are being exported, for United States natural gas liquids, that's structurally higher, about 40%, heading towards 45% towards the end of the decade. So that means when we talk about importing volatility, you import more volatility on the NGL value chain, and we saw plenty of that in 2025. We saw trade disruptions with China. We saw lots of port fees, carrier fees, shipping fees, and kind of tariffs all throughout the place. They really disrupted and shook up global markets. So when you're heading to kind of an unexpected market like that, that volatility would impact your value chain quickly. And if you can't move those barrels and get them in the water, like you said, you risk increased storage, which will eventually kind of back up throughout production.
Yep.
And more locally, kind of a constraint that we're seeing there is on fractionation capacity. We expect really 100% utilization of Mont Belvieu fractionators until kind of the third quarter of 26, where we do expect some relief for some projects to come online. But until then, really watching fractionation capacity at Mont Belvieu is going to be huge. So in this situation, who wins? It's a couple of things. It's operators who have flexibility at the dock. So you're talking about Enterprise, Energy Transfer. Nature's River Phase 2 has a flexibility between ethane, propane, or LPG. So those are kind of the operators that are set to win. No matter where the disruption is, they can toggle and switch to the most benefit there.
Hey, Julian, I have a question. What this is Mont Belvieu frac capacity. What about like Conway or other fractionators across the U.S.? Like, how does that look as a total U.S. frac capacity?
Yeah, that's a good question. So Mont Belvieu frac capacity is the one that has the most stress. There is some open space in Conway specifically. The issue there is that the Permian production of natural gas liquids finds its way to Mont Belvieu. There's not really pipes or infrastructure to take it from the Permian to Conway. But that doesn't mean that there's not opportunity at Conway. And we expect ONEOK to pull in more Bakken NGLs, fractionate them at their new or at the rebuild of the Medford fractionator, and eventually bring it down to the Gulf Coast.
Okay, so opportunities there, and then your last bullet, right? So your NGL production is increasing, right? If there are builds in storage, that's a good thing for NGL consumers like Novachem and Satellite and those guys.
Right. If you have trade disruptions internationally, you're going to benefit domestically with lower prices. Higher storage correlates with lower prices, and we've kind of seen that in 2025 where we had record storages for both propane and ethane. So making it a lot cheaper for already entrenched players domestically to run their facilities.
Gotcha. Okay. Well, that's great to see here. This is why we forecast everything, all at once, right? Because different commodities impact other commodities. All right. So speaking of, I guess flipping back to gas, right? This is our capital discipline slide where we talk about Haynesville producers. Fool me once, right? That's in reference to the price run up in 2022. This most recent price run up, right, or what we expect in the future, also in 2026, we think this is legit because this is backed by structural demand, right? If Haynesville producers cannot get 3 BCF a day higher by the end of 2026. So looking at DEIS to DEIS, there's even more upward pressure on gas because you go from a undersupplied situation to an even more undersupplied situation pretty quickly. So that's kind of what the pink arrow there represents on the right. And we do believe regardless of this most recent price surge that was, kind of weather based, that by the time you get out to winter 26, 27, and you layer on 4 BCF a day of structural demand, that, things like the weather, not that they become less important, but they also introduce more volatility and more asymmetric risk to push that price consistently above $5. Real quick here, this is the infrastructure timing piece, right? You've seen this slide before. It basically demonstrates the build out of capacity in the Permian and the Haynesville and the general Southeast Gulf, right? Point of this slide, I think, is that this year in 2026, those gold projects that you're looking at, right? It is really kind of an overbuild. But the reason why it's an overbuild, Jackson, is
because there's these long dated LNG contracts. So you're allowing these operators to position themselves with 20 years of visibility. So for the first time, they can get ahead of the supply.
Yep. I was trying to throw Jackson under the not under the bus, but just give him a little shock moment there, and he got me. He got you guys too. Anyway, that's a great answer. Yeah, so pipelines like Hugh Brinson, right? They're probably even a little bit ahead of the data center movement, right? Certainly, Blackcomb and potentially Blackfin with their LNG facilities not really coming online until mid 27. They got some runway there. So anyway, we think 2026 is a little bit overbuilt for all intents and purposes, and that will play some catch up in 27, just in terms of when actual enhanced LNG exports take place. Now let's talk about political hurdles, right? So this is an interesting slide here on the Eastern Seaboard. You can see that 2025 largely consisted of the kind of these brownfield, smaller projects, right? This was the net result of really, like call it the disdain for gas infrastructure projects along, a lot of these corridors, right? I think what's becoming apparent, and I'll throw this over to Ian right here, is that there's a real need for gas-fired power burn, and what else? Like, what does this tell you, Ian?
Yeah, well, power burn is definitely a huge part of it. We know we've got Data Center Alley there in Northern Virginia. We know that we've got a couple of projects like Commerce City and Shippingport that are going to be large data centers demanding a lot of gas. We're seeing those data centers starting to relocate in basin, but that isn't necessarily fixing all of those problems because we still need to actually move the gas around in the Northeast.
Yeah.
One of the problems.
How long did when was our last greenfield pipe there
Yeah,
besides OVC?
MVP. Yeah,
MVP. Yep.
Mountain Valley Pipeline. Yeah, it was supposed to be a 4 year project with a $3 billion cost. I think it ended up tripling that and taking 10 total years. So it's
and an
tough.
act of Congress. Don't forget.
And an act of Congress.
Yep.
It takes a lot of effort to get a greenfield pipe through here. So there's quite a lot of hurdles at both the state and federal levels. And while this administration is certainly more supportive of these projects, you still have some statewide hurdles that need to get cleared. And these projects, as you can see, are trying to do that. But looking through this list, you can see that most of these projects are relatively small, 400 or 500 MMCF per day. And that's simply just because they're compression expansions. They're still struggling to get those greenfield projects actually up and running. And I think MVP has created a little bit of fear in the markets in terms of building out that kind of infrastructure that's needed. So we might actually have to see some fundamental shift to demand increasing in this region before we actually start seeing larger projects getting constructed.
And I think generally speaking, there's a little bit more sensitivity to energy affordability issues.
Certainly.
That constituencies will put their vote on, right? As things gradually get more expensive and you feel like you're getting nickel and dime by everyone, right? Including the utility companies, you're gonna vote with with that in mind. So
Well, PJM's a good example of that, right?
Yep.
I mean, PJM largest auction yet again. I think that's 3 in a row. I mean, those prices are going up like crazy, and people don't want to have to pay for that.
Yep. So, does that clear the way for more projects, or does it actually like put the in-service dates of these projects, into reality, right? We shall see, but certainly I think everyone has kind of felt a change in that political sentiment that some of these projects can actually, not take an act of Congress to complete. So anyway, that's enough on politics. Let's flip over here. So we just went through the gas as a growth engine kind of section, right? And we identified the challenges of capital discipline, of infrastructure timing, and politics, right? Let's talk about capital markets. This is kind of where I want to finish it. And we'll go back to Jackson to talk about how some companies are trying to control what they can control in this new global environment.
Sweet. Thank you, Jack. So what we're definitely seeing is doubling down or owning your lane within each of these companies and all of the major players within energy. So just as these markets get more mature and more competitive, you want to be able to fully control the area you're in. So and if you can't have the scale to compete against the key players in it, then get out. Sell that business segment or asset and divest it to focus on your core portfolio. So great example of this, like Julian was saying, 40% of NGL barrels clear on the water. So Targa, following that wellhead to water strategy, focused on NGLs. They're expanding their plants, pipes, fractionators, and export infrastructure to capture the margin all the way from the wellhead to the water. So great KPIs you can watch for these companies.
Well, not only are they KPIs, but they're things that you can get through East Daley.
Exactly.
Yeah.
Great things you can see via EBS is rigs on Target systems.
Yep. That's in our rig tracker,
In
right?
the rig activity tracker, you can see plant inlet and NGL production through our GMP system analysis. And then we also track producer guidance as well. So that's Targa. On planes, we're calling them the crude contrarian. As Keelan touched on, demand growth is very soft, right? In a very mature, modest growth market here. So in order for planes to capture incremental margin and maximize on their business, they have to invest in scale and maximize that network effect of their infrastructure. So they divested their NGL business to Keyera and reinvested that into crude pipelines in the Permian. So again, you can track some KPIs, our Permian rig activity, where you can see on EDS, the crude hub model, where you can watch flows on all of their pipelines, as well as the contracts and forecasts out into 2030. And then Williams, following this gas is the growth engine trend, very interesting strategy where they got some behind the meter power generation that they're in the queue for years ago and are using that to capitalize on their core midstream business. So they're following that gas to power generation, chasing after this AI infrastructure demand, where they can get toll backed infrastructure like revenues and income on these power gen projects that are very similar to a midstream economic model. So they're defending their core midstream business, like Ian and Jack were talking about in the Northeast. A lot of those projects are expansion projects, and over half of those expansion projects are Transco expansions. So Williams is heavily defending their midstream cash cow and investing it then in either expanding that further with the Transco expansion projects, overthrust expansions, and Northwest as well, and then investing in behind the meter gas to power.
Yep.
And we're tracking all those project startups and timelines through the permitting and where we can see them applying through those like air permits as well as land permits for the power gen.
Yeah, I mean, you can go to our data center demand monitor and just flip on Williams to see how many data center projects are in proximity to Transco and other assets that they have. So yeah, this is great. All right, so here's another. Geez, we're just giving away secrets this entire month, but here's another way how you can use East Daly's G&P tools to evaluate assets. And Jackson has gone through this to figure out like what are some of the most underutilized systems that might not become so underutilized in the future.
Yeah, exactly. So I came up with this list by looking at the GMP dashboard on Energy Data Studio, and it took me, based on our macro call, 2 minutes to get. And this is a short list. There's a long list as well. So this macro call is based on the demand growth that we're seeing through LNG, forcing this wider supply set, and creating a multi-year call on gas. And the constraints of will the Haynesville ramp in time to perfectly balance the market, or will it not? Are creating this interesting market dynamic, especially with Haynesville inventory being finite. And there's different producers within that. Some of them are like Japanese JERA or Tokyo Gas that may not want to ramp just on a high gas call, and they're defending their energy future. So with all of this together, this creates these non-core assets being call options on higher gas, right? And these systems will quickly move from marginal to high operating leverage. And this short list you're looking at on the right has been cross-checked with our macro call, as well as portfolio optimization that these companies are talking about, where they've already divested or talking to, focusing on regions that
like ET in the Rockies, for
exactly,
example, right?
Yeah. And so great example of like MPLX bought Northwind in the Permian and divested their Rockies assets to Harvest. So that's a great example of how we came up with these lists from portfolio side as well.
Yeah. I also think location matters here as well. Like you look at some of those assets in the Barnett, right? I mean, the Barnett is right on top of all of this LNG growth, right? So there's going to be some production growth there as prices rise, which makes these things more valuable inherently. So yeah, good macro call there on the equity side based on what we see coming on the commodity side. All right. Well, any parting thoughts from anyone here? Very briefly, we're gonna flash through these production change slides here, looking at Nove to Dees. We don't have to spend a lot of time on this. Again, if you are a client, you obviously have access to this presentation and the deck. Don't be a stranger. If you're not a client, we have some things to talk about with you, right, in the future. So, obviously we have a lot of daily and weekly content in addition to our monthly calls. Definitely do reach out. All of our contact information is here, including the phone number, and the important email to remember there is insight@eastdaily.com. Obviously, we monitor our own inboxes, but that inbox is monitored by like 6 people. So, really good way to communicate with us there. Finally, thank you. We're really excited about 2026. We're looking to see which one of our prognostications come true, and then how to navigate this kind of volatile commodity and midstream equity markets. So, thank you, and
Yep. Thank you, guys.
all right, very good. Well, we will catch you next month with the February update. Thanks again, and enjoy the rest of your week.